Good day, fellow investors. 5 European stocks analyzed, and of those, 2 are actually a buy for our YouTube portfolio. So we immediately start working on that we discussed yesterday in the video. All these ideas come from your suggestions. I thank you all for those analysis suggestions, but please, I reiterate myself, elaborate on why I should analyze your suggestions so that we add more value into the comments below. If you enjoy these analyses, please smash that like button to support the channel. It really matters a lot. And if you haven't, subscribe and click that notification bell as we do educational content, as we do stock analysis, so you see what better fits you. And also we do market commentary and some micro, because a lot of you like that. So for that, click the notification bell so you see up what fits you, what doesn't. And that's how a YouTube channel best works, I think. Thanks for your support. So let's immediately start with the stocks. Rubis, pardon my French, probably said it wrong, so excuse me, pardon-moi, but let's start. The company is a French-based international specialized in the storage, distribution and sale of petroleum, liquefied and petroleum gas, food and chemical products. So very boring company. It is the market leader in France, Switzerland, Bermuda, Jamaica, Madagascar, Morocco, French Antilles, Senegal, Channel Islands and Kenya. So global company in a very boring business, storage, distribution and sale of petroleum. And boring businesses mean also bad stock price performance. In Europe, everyone is going away from petroleum. We are suddenly over the last 2-3 years all very environmentally friendly, and nobody is driving petroleum cars anymore, and nobody wants to own a company like Rubis anymore. So better dump it in the dumpster, and then you see what happens when suddenly every pension fund changes and has to dump it. This happens. The stock is down 65%. If we look at the valuations, the P ratio is 7. And yes, you're reading this correctly. The dividend yield is 8.33%. There are some French taxes likely on that. Check that with your broker. But 8% is a lot. And let's look into the business. So I'll go through the 2021 presentation. And as you can see, distribution of fuel. So also retail. And they do that across the countries. They do increasing the dividend over time. So they also go into renewables because they have to, because the pension funds are dumping their stock. So they are also working on reducing everything. So if they can manage that, maybe pension funds will buy back one day. But if we look at the performance over the year, the cash flows are around 400 million, pretty stable despite oil prices going up and down. Net income 293 million. Compare that to the market cap and you have a P ratio of 7.8, which is pretty low. So they have the retail and marketing part, trading, shipping, logistics, refining part, storage of liquids, chemicals, food, fuels. So all things that we need, but now it's not a cool thing to invest in. And you can see here a dip during the pandemic, but still very profitable. Strong margins, so nothing wrong with the company there. They have really good cash flows, and even the net debt to EBITDA is not that crazy. They have taken some debt to make some acquisitions, so that's okay, but they also sold something, so also got returns there. And they are working on the CSR approach, so should be okay long term. They did just an acquisition of Photosols that in France, and then also hoping to do the same thing, using the knowledge there to expand to all the other countries they are operating in. So if they can do that, they can really grow it over the long term. They have the money, they have the knowledge, they have the connections to go into those countries where if you finish Harvard, you certainly don't want to focus there. You want to be in Coinbase and other Bitcoin things. So less competition also with the negative sentiment that's related to the sector. They look for growth, renewable, increase of renewables contribution to EBITDA, improving performance, strong balance sheet, dividend growth, cash flow growth, nothing bad, so except for the stock price being in the dumpster. And they have also pretty stable margins and profits unrelated to shenanigans with oil prices. Now, this is something they had to do likely, and what can I say? This is Europe. Pension funds own the stock. What can we do here? It is what it is, but it can also in the long term be a good idea and likely get to some interesting returns, especially if they can potentially expand it to all the other companies that Ruby is involved in. So if they can do it, that should again be a good contributor and also compensate for maybe declines in the core business. So it's a boring business, stable company, profitable. It's going green, might be questionable. The valuation is really cheap. It is still growing, especially as most of it is in emerging markets, I think 70% of revenue. So even if Europe starts declining because of all of these ESG and everything, then okay, still Africa and emerging markets, I don't see Tesla entering those markets that fast. It has a great dividend, good buybacks. They also did 150 million. They likely continue. The problem is it is on the European stock market, so it is traded and 90% owned by pension funds, I think. So that is what brings the stock down, can bring it even lower. No worries about that. Can go even lower. But at some point, these fundamentals should matter. Let me know in the comments if there are some detailed issues. I didn't find them, but that's why I'm adding this to our portfolio, YouTube portfolio. I have here put the price in. I have adjusted the purchase to dollars and euros at the time of purchase, and the price now will be reflected and adjusted also with the euro-dollar exchange, so as those go up and down, to have it reflected in dollars, and then we'll see the loss and gain when the time comes. This is early Monday morning, so no losses and gain. I'll put here the link of this video for the analysis and write the thesis that it is cheap, boring, 8% dividend, and growing. So that is then the summary. And we'll see over time, we'll update on earnings, etc. And that should then add value to our investments. Let's continue. The next company that a lot of you suggested is Veolia. Big business and just acquired Suez, so regulated businesses, and they have made a rights issue to get some money to pay it, so that will likely dilute people a little bit later. But okay, 2.5 billion, that should be around 10% of the company. There is always a lot of things that go on with these big regulated businesses, so that's something to keep in mind. But still, you can see here social commitments that they have it. I don't know why it is important that the majority of shareholders is still French, but okay. There will always be these political issues related to it, so something to keep in mind. But what's important for investors, they propose to increase the dividend by 43% to currently €1 per share, so good dividend there. And if we look at the free cash flow generation, it is around 1 billion, and they expect it to be around 1 billion. Now that they have merged, this is a little bit higher, 1.2 billion, I think, and that is unfortunately 18 billion, but we'll see now in a moment. So what they do: municipal water, water technology, solid waste, hazardous waste, local loops of energy, energy services, industrial services. So this is interesting, but this also depends on European industry, which might not be in a great place longer term. So also there are some risks. As they merge with Suez, EBITDA will go higher, so also likely free cash flows, but this is also an issue now, and that's the combined debt of 18 billion. That's net debt, which means that gross debt is even higher. And if we compare this to the market cap, 16 billion, the debt is way higher than the market cap, which is also the main risk. The dividend yield is 4%, maybe will grow, but not really that stellar. And they confirm earnings per share increase by 40%. That should also increase the dividend to then 1.4 euros per share. But 1.4 euros per share, still not stellar for a company of these risks, because I see risks in the debt, the gross debt there, the regulated environment, and if debt and interest rates in Europe go higher, this will be an issue also to refinance and everything. So something to watch and be careful with. So even if, yes, they make 1 billion as a group, likely 2023, so the dividend will likely go higher, I don't think one can sleep well at night, because yes, it is a big company, it is a necessary business, but it is related to economies in Europe, high debt. You can't sleep well at night by owning such a high debt company. The positive is that the dividend will go higher, but are we paid to run the risk? Rubis has an 8% dividend yield, this is a 4% dividend with much less debt and everything. So I don't know, I would prefer a small cap like this, also essential to how we live in Europe and emerging markets. So there is always regulation, so not for me. You can do 100% in some circumstances, so this can go to 50 as it was a little bit now, maybe 50%. This can go to 36 if they increase the dividend and interest rates in Europe stay low, but if not, this is likely a negative scenario there. Next business that many of you asked for is E.ON. So many questions, of course, as the stock performance hasn't been stellar. Of course, there is the dividend, but this doesn't look good even with the dividend. And we'll just quickly discuss what's going on. The dividend is already 6%. The price earnings ratio is ridiculously low at 4. But why is this so cheap? And let's see whether it is an investment. So E.ON, regulated authority, of course, energy, power distribution and everything in Europe. The dividend there of 49 cents, strong EBITDA, net income of 2.5 billion. Compare that to the numbers here and you can see that it's really cheap from that perspective. And even on top of that, they expect dividend growth of 5% per year over the following 5 years. So that should be 75 cents, 80 cents over the next 5 years and then continue to grow, which means that this should yield 10% on the current stock price in a few years. And they say that the capital structure is strong, but I always laugh because we just listened to the Seth Klarman interview. Check that one, it's great. And he said how these ratings are made by 26-year-olds at Moody's. So always take these ratings with a pinch of salt. And I look at their guidance and it's really remarkable. They have everything planned and set up like nothing is wrong. Return on capital employed stable as it is regulated, so not extremely high, but their debt factor is something to really be concerned, because if interest rates go higher, their return on capital employed depends on regulators, so their margins get squeezed, and that's why you see the stock price going down. The market doesn't like it. The market doesn't like also the capex of 27 billion euros. That is also going higher with inflation and everything in Europe, with materials and everything going higher. So their projections are being squeezed, and maybe they just haven't updated this yet, because they have regulated their returns depend on the regulator assessing the value of their assets. So that's a regulated business. You can see here how it all depends on what regulators decide, and that's always a risk. If there is a bad situation in the country, these decisions will be likely ugly. So huge capex, this can easily go to 30 billion and more, which means there is nothing left for dividends, so they might have to cut that dividend, not grow it 5%. These are, let's say, precise projections on volatile things, on volatile factors. Capex, 10% inflation per year, and you are already at 35 billion, while you can't really increase prices because you have regulated pricings. And then there is also the debt issues. huge debt, something long term, okay, but this has to be refinanced at higher rates. So that's again an issue. And if this becomes an issue, then you can't refinance, and then there is really a lot of bad that happens. So regulated utility, high debt, growth based on assumptions that might not materialize, not to sleep well at night investment, despite the dividend, even if you get paid to try to sleep, but watch the dividend cut. Even if cheaper is better, the stock is going down, so it's a much better buy here than here. Maybe it will rebound, you get the dividend, but this can turn into an ugly investment, so not something that I would add to my portfolio. Next one is Devro, UK business, and it all is about how much you love sausages. So Devro is a business, and we all know that our sausage is the most important thing in our lives. So they produce collagen casing and supporting to have their customers put their sausage into it wherever you are in the world. So always protect your sausages, because you never know. As Charlie Munger says, always avoid AIDS situations. So they have 85 years of experience in doing that. It's certainly a boring business. The stock has been pretty stable, of course, pandemic issues, but then up, and now again on the cheap side. Market cap just 307 million, so a small cap stock, again likely not under the radar of Wall Street of everything. P ratio just 10, dividend yield 5% with growth projected ahead. Let's check the investment case. I hope you don't get hungry. I don't eat sausages, so it's irrelevant for me. So number one, in many countries, they provide these edible collagen casings. They have significant growth potential. Their underlying market growth is estimated at 2 to 4% globally. So they have new products, global capacity. They are now building even more somewhere in China, I think. So good cash flow generation. They have an attractive progressive dividend that they hope to grow. And if we go to the presentation, really good numbers, emerging markets up, mature markets up. So they are really consolidating into their business. They have done some acquisitions bad in the past that had put pressure on the stock price, but now looks all solved, all better. So profits up, debt is relatively low, way below the covenant, strong cash generation, free cash flow of 36 million pounds compared to the market cap. That's a free cash flow yield of 10-11%, so nothing wrong there. There is the dividend going higher. They have the cash flow to pay it, so 50% payout. The operating margins are pretty stable, so if they can increase that and work on savings, increase production efficiency, everything, not much competition there, that not many people that will go into the sausage collagen casing business. I think that's not your dream as you grow up as a kid, so pretty stable there. There is a pension deficit, which is always something you have to watch when it comes to European stocks. They look for growth ahead, nothing wrong there. Group revenue 29% in emerging markets, that should grow significantly, and also in developed markets should be pretty stable. They are increasing capacity, growing, also looking for acquisitions, organic growth, progressive dividend. So capital allocation, if they do it in a good way, they should hit their outlook, grow free cash flows, increase business, etc. As long as the world keeps eating sausages, which is something, of course, not that healthy likely, but if you continue to do that, there should be the niche business, low valuation, good dividend. It is not cyclical. You got to love your sausage. Slow and steady growth globally. Small cap makes it interesting. Not much competition, and it is definitely a contender to our YouTube portfolio, and so I have added it here. Put the price of the analysis on Sunday that I made, also prepare this video, and we should then watch it over time. So here is the thesis: niche business, good div, growth ahead, and we have to see how that develops over time. So we are already now at then 4 stocks and still 26 to go, so I really hope you enjoyed this from this perspective. Next very much requested stocks is Adidas, and you can see here how the stock got hit pretty hard recently, so down 47% over a year, which might create some irrationalities because it looks like a good business. Price earnings ratio 15, dividend plus buybacks yield is also good, likely 4-5%. Market cap 32 billion for a company like Adidas. Let's look into the business, and this is the main issue. So Greater China down 35%, but I think this should be a temporary issue, not a structural issue. So when this recovers, then also the stock price recovers. I'm always very surprised by how the markets react to these shoemakers, because when things are good, everyone is very excited, then some issues, and then it really crashes. This is really remarkable. Excitement, crash, and that happens constantly over the years, and it seems like the market is always so focused on the short term with these businesses. So that's something to watch, but they are growing 30% in Western markets, which is really remarkable. Strong gross margins, and just a small dip in gross margins because of current inflation supply issues. That's 2 percentage points, makes a huge difference on the bottom line, and immediately the market assumes that these margins will be forever there and not these, and revalues the stock completely. If they manage to improve the margins because of sourcing issues, mix, and keep the pricing strong and bring it back to 52%, they will make a lot of money, and longer term they should be able to return to normal gross margins. Of course there will be ups and downs, which is normal for every business, but if they can work this, and also you can see the lead times compared to earlier, so a lot of shoes on boats now that you cannot buy, and which increases the cost of doing things. But still, no matter that, they still expect to have a good return, let's say 6 billion over 3 years, that's 2 billion per year, that's 7% shareholder return, still working on that growth, and also with China being locked down, that should also recover in the second part of the year. Very interesting here, Foot Locker strategic partnership. Now Nike has kicked Foot Locker and they are trying to take that place. So going behind Nike, I've looked at Foot Locker here in a video. We'll put the link in the description below. But it is now at 26, so avoiding, and I don't know, let me know in the comments whether their buybacks are working or not. Seems not, given that the stock price is going higher. Likely some issue, and this was just an announcement to push stock prices higher. Not a followed stock, so let me know just in the comment for my curiosity. And they expect the business to grow double digits, and if they can continue to grow long term in China, then we'll should be looking at double-digit growth. Plus, when margins improve, that should lead to strong growth in net income over the long term, and therefore the net income should even double over the next 3-4 years. And if that happens, then you have, I don't know, 4 billion of net income, 3-4 billion, P ratio of 10, higher dividend yield and growth, which makes this a good business now at a cheap price. We are back to 2017 levels. But it looks like the market is scared, and if this happens, the stock will likely double. The question is, I don't know, will we just keep buying more shoes? And I must say here, don't bet against my wife. I have a lot of Adidas, and my wife says that I am too much of an Eastern European Balkan boy when I wear Adidas, so she said no more Adidas. So if I follow my wife, and she has always been prescient on these stock calls, the stock is going bankrupt. So if the trend changes and people go to something else, I must. So that's just a funny note there, but I'm never going to bet against my wife, so I've lost that too many times. So not for me, Adidas stock is. But this really looks interesting, and I have seen this many times. Also Skechers, which is a followed stock on my research platform, very, very volatile, but the underlying business is strongly growing, and then you have to see how this fits you and how that works. I already added two to my portfolio list. This looks interesting, but let me know if it goes down another 30% on negative things in Europe. It already looks like an interesting buy, but if it goes lower, then we'll likely add it, even if my wife says I should not wear Adidas anymore. So from the buys, we did Devro, niche business, small cap, low valuation. Adidas is a big company, so not much value to add there. If it goes lower, we can discuss that. So not cyclical for the sausages. Very interesting to learn about from a business perspective. So nothing wrong there. This is the purchase price also put in here. This is stable, and the rest should adjust, price now should adjust automatically as I refresh the data. You can download this on my stock market research platform. So this is the premium version. If you just scroll a little bit down, there is a direct link in the description below. This is the comparative list of publicly analyzed stocks, and you can download it here and also read everything, how it works, what it works, and how things go, how to calculate intrinsic value, etc. Next company, Rubis. Again, liquids and everything, ugly business, low investments, nobody wants it. Pension funds in Europe dumping it for sure, which makes it cheap from every perspective, and the dividend seems attractive so that value investors can start buying it. Let me know in the comments if I'm wrong somewhere here. We will follow it over time and learn more about it and see how it goes. Check my research platform for my premium analysis for what I really own in my core portfolios. Thanks for watching. Subscribe, smash that like button. Looking forward to more of your elaborated suggestions, and I'll see you in the next video.